Imagine a world where a single decision in Washington, D.C. can send ripples across the globe, affecting everything from your mortgage rate to the price of bread in Brazil. Well, that world is our reality, and it all revolves around the Federal Reserve's interest rate decisions. Welcome to the Economy Unpacked daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. The Federal Reserve, established in 1913, is the central bank of the United States. Its core mission is to maintain economic stability, manage inflation, and ensure full employment. Over the decades, it has evolved into one of the most influential financial institutions in the world, shaping not just U.S. policy but also global markets. But how exactly are these crucial interest rate decisions made? The Federal Open Market Committee, FOMC, meets roughly 8 times a year to review economic data such as inflation rates, unemployment figures, and GDP growth. Based on this data, the committee decides whether to raise, lower, or maintain the federal funds rate. These decisions are guided by the Fed's dual mandate: price stability and maximum employment. So why does the Fed raise interest rates? One primary reason is to combat high inflation. When inflation rises too quickly, the Fed increases rates to make borrowing more expensive, slowing down spending and investment. This helps reduce demand, which in turn eases price pressures. Another reason is to cool down an overheated economy. If economic growth is too rapid, it can lead to asset bubbles and wage price spirals. Higher rates can slow down borrowing and prevent the economy from overheating. Lastly, raising rates can strengthen the U.S. dollar. Higher interest rates attract foreign capital. As investors seek better returns in U.S. assets, this increases demand for the dollar, strengthening its value relative to other currencies. But what happens when the Fed pulls this economic lever? The immediate effects on the domestic front are significant. U.S. stock and bond markets often react swiftly. Stock markets tend to respond negatively to higher rates, because borrowing costs for businesses increase and future earnings become less attractive when discounted at higher rates. Bond yields, on the other hand, tend to rise, but existing bond prices fall. The housing market feels the impact too. Higher Fed rates make mortgages more expensive, cooling demand in the housing market and potentially slowing home price growth. For the average consumer, this means higher costs for credit cards, auto loans, and personal loans, which can reduce spending and slow the economy. But the effects of Fed rate hikes don't stop at the U.S. border. They send shockwaves across the global economy. One major impact is capital outflows from emerging markets. Higher U.S. rates make American assets more attractive, prompting investors to withdraw money from emerging markets. This can destabilize their financial systems. Currency depreciation in other countries is another consequence. As investors move money to the U.S., demand for local currencies drops, causing them to lose value against the dollar. This makes imports more expensive and can fuel inflation abroad. Additionally, trade and export slowdowns can occur. A strong dollar makes U.S. goods more expensive overseas and foreign goods cheaper in the U.S., potentially reducing global trade volumes. To understand the global impact, let's look at some case studies. The 2013 taper tantrum is a prime example. When the Fed announced it would slow its bond buying program, global markets reacted violently. Emerging economies saw capital flight, currency devaluations, and higher borrowing costs. Different regions react differently to Fed hikes. Many Asian countries have had to intervene in currency markets to stabilize their exchange rates. In Europe, higher U.S. rates sometimes coincide with financial tightening, creating pressure on the Eurozone. Latin America, with its history of debt crises, is particularly vulnerable to these changes. So why does the world fear Fed rate hikes? One major concern is the potential for debt crises in developing nations. Many developing countries borrow in U.S. dollars. Higher U.S. rates mean higher repayment costs, especially if their local currency weakens. There's also the increased cost of borrowing for governments and companies. Sovereign bonds and corporate debt become more expensive to issue, straining budgets and investment plans. Perhaps most concerning is the risk of a global recession. Simultaneous economic slowdowns in multiple countries triggered by tighter financial conditions can tip the global economy into recession. Given these risks, what strategies can be employed to prepare? For investors, diversification is key. Allocating funds to assets like gold, U.S. Treasuries, or defensive stocks can help reduce risk during volatile periods. Businesses need to focus on hedging currency risk and managing debt. Companies can use financial instruments like currency forwards to protect against exchange rate swings, and they can refinance debt before rates climb further. For individuals, managing personal debt and implementing saving strategies is crucial. Paying down high-interest debt quickly and locking in fixed-rate loans can protect personal finances. Increasing savings can also provide a buffer against economic uncertainty. Looking ahead, what can we expect from the Fed in the next 12 to 18 months? Analysts are closely watching economic indicators to forecast whether the Fed will pause, continue hiking, or even cut rates depending on inflation and job market data. The path of interest rates will have significant implications for global growth. In a best-case scenario, inflation eases without causing a severe slowdown. The worst-case scenario involves aggressive hikes triggering a deep recession and widespread financial instability. As we've seen, the Federal Reserve's decisions have far-reaching consequences that extend well beyond the borders of the United States. Understanding these dynamics is crucial for navigating the complex world of global finance. Whether you're an investor, a business owner, or simply managing your personal finances, staying informed about Fed policy and its global impact can help you make better financial decisions in an interconnected world. Remember, in the realm of global economics, what happens in the U.S. doesn't stay in the U.S. The ripples of Fed decisions can turn into waves that crash on shores around the world. Stay tuned to Economy Unpacked Daily for more insights into the fascinating world of global finance and economics.